You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Welcome to Marketplace Minute. I'm DeLegge with ETFguide. Has the Federal Reserve's QE pumped up asset prices to dangerous levels? We're pleased to have with us Cullen Roche. He's founder of Orcam Financial Group and proprietor of the Pragmatic Capitalism blog. Cullen, great to catch up with you.
Hey Ron, thanks for having me.
Let's begin with the 411 on QE. A lot of misunderstanding about what quantitative easing is. Talk about that.
Right. So quantitative easing is simpler than I think a lot of people make it out to be. It's really just a form of monetary policy in which the Fed expands their balance sheet to try to positively influence the economy. And they do this by essentially creating money from nothing, and they change the composition of the private sector's balance sheet through asset swaps. So the basics of QE is that it's a form of monetary policy that involves asset swaps.
Very good. Now, I want to ask you about the linkage of asset prices and quantitative easing. There's been a serious decoupling. For example, gold prices have fallen around 35% since 2011,
right.
Yet gold bugs continue to link the performance of gold to QE, yet it seems like there's a disconnect.
Right. So a lot of people, I think, when QE began, they thought that QE would cause inflation because it was referred to as money printing. There was a lot of the mythology about potential hyperinflation, high inflation, and I think a lot of people positioned their portfolios in a way that they wanted to buy hard assets. They wanted to get out of dollar-denominated assets and into gold, real resources, commodities, things like that. And I think that what's transpired over the last few years is that we've realized that QE really isn't money printing so much as it really is just asset swapping, and they're not changing the net worth of the private sector. So there hasn't been this high inflation as a result of the policy.
You say something very interesting on your blog. You say that QE's primary mechanism or benefit is through its ability to alter psychology, thereby keeping interest rates lower than they might otherwise be.
Right. So this gets into kind of the dynamics of how people are positioning themselves. So what the Fed's doing is they're changing the composition of the private sector's balance sheet. And in doing so, they're forcing investors to reallocate their assets. And this has had not only a portfolio rebalancing effect, but it's had a really powerful psychological impact on markets in that it's forced investors out of certain assets into others, but there's also been the mythology driving all of this. And people have been reallocating assets into things like gold and commodities, and we've seen these huge moves in asset prices over the last few years where the psychology has driven markets up. And I think what we're seeing to some degree now with gold prices down so much, for instance, last year, is people are beginning to realize, oh, maybe QE doesn't do everything that the mythology said it would do.
What about, one last thing before you take off, what about long-term bonds? Long-term U.S. Treasuries, which we have seen fall very hard in price here over the past year or two. What are your thoughts about that particular asset class?
Right, so bonds are interesting. Bonds have seen a big move due to what's referred to as the tapering, and this is the Fed unwinding QE. So people are worried that the Fed is going to, I think, move into a period of interest rate rises, and I think that some of this is again based on mythology, and that people are, I think, misperceiving the way that the Fed might raise interest rates over the course of the next few years. I actually think that the Fed is likely to keep rates at zero, and I like to refer to tapering as it's not money unprinting so much as the tapering is really just it's less money printing, if you want to call it that. So the Fed's still expanding their balance sheet, they're just doing so at a slower pace. So I think that to refer to this as, I think, a tightening of monetary policy is misleading to some degree. So I think without the interest rate or the inflation effect and the higher interest rates, I think that it's going to be very difficult to see a sustained bear market in bonds in the next few years.
You just heard from Cullen Roche, founder of Orcam Financial Group and proprietor of the Pragmatic Capitalism blog. I'm Ron DeLegge with ETFguide. Thank you for joining us on Marketplace Minute.